the market's waking up to what the Fed intends to do, rather than a reflection of Chinese buying or the BOJ and some stealth tapering going on there?
I do. I mean, I think as a rule of thumb, and it's, you know, we have rules of thumb, sometimes they're dangerous, but as a rule of thumb, I think it's more dangerous to view flow as the main determinant of prices, and it's always right to view fundamentals as the main determinant of prices. You know, bond markets are extraordinarily efficient. And, you know, if someone is not buying, someone else will step up to the plate and buy it. And the truth is that as yields tend higher, there are plenty of constituents within the market who will be keen to snap up those yields, pension funds and insurance companies. So I think that the Chinese flow argument is not the key determinant. It's much more a recognition, maybe belated, of what's going to happen to the US economy as a result of the tax cuts, and also this sense that inflation is trending up.
And indeed, we did have a bond auction last night where they came like honey to the pot, didn't they? It was the best bid to cover ratio since June 2016. It's interesting that you talk about the backdrop. So we caught up with the Goldman Sachs chief economist yesterday, Jan Hatzius, and he talked about the tax adding about a third of 1% to the US growth, but he also talked about financial conditions in the United States of America as being incredibly facilitative, and that's what I've got here for you, Stephen. As you see the US, the growth story, does it add to the equity story? And we're going to have these little moments of tremor. This is financial conditions in the United States. It's very accommodative, and this is one of the drivers, according to Jan Hatzius, that's certainly going to drive the market up. They reckon it's moved from -1% to +1% in terms of financial conditions, benevolence to the market.
Yes, I mean, I think that's true. You can also see it if you look at the credit conditions index, so the credit standards being applied by US banks. There's been absolutely no tightening at all. In fact, if anything, in the last 3 to 4 months, there's been a slight loosening. So, in other words, credit standards are kind of just a little bit looser. We haven't seen an enormous credit surge within the United States, despite the fact that the recovery there is, what is it now, 9 years?
It's long.
It's long in progress. We were also looking yesterday at house prices in the States, and I don't know if you've looked at those recently, but Case-Shiller, the house price index, which was one of those key charts that everyone was looking at back in 2008, 2009, that's back to the highs. You know, it's in a very unheralded, quiet way, house prices have just simply recovered all of the ground that they lost during the financial crisis. Now, you would expect that because house prices are a nominal measure, and nominal GDP is expanding. But, you know, all of the signs are that the economy is still expanding in a constructive way. Very few signs of strain, and with the likelihood that there is going to be a further extension of this as we go through this year.
And how much of that is priced into equity markets then? Because we understand the robust picture in the United States, but we've seen, as you say, we're 9 years. It'll be 9 years, won't it, in March this year? 9 years since the bottom of the equity markets post the financial crisis, or middle of the financial crisis. How much further does it have to run?
Well, a lot of the recent move in the American equity market, to my mind, has been discounting the tax cuts. I mean, there was some debate as to whether those tax cuts were actually going to get through Congress. They did. And since then, there's been a net revision upwards to estimates for American profitability in 2018, and we're seeing that from analysts. And therefore, equity prices have adjusted upwards. But I think, you know, that's like a sort of a one-off, if you like, the tax cuts. But as long as the recovery stays on the road, it's possible for equity markets to continue to power ahead. I was having this conversation with Tom Keene a week or two ago, and he was saying, you know, wow, you know, Dow at 25,000. Of course, the Dow is a nominal measure, and if you look at US nominal GDP, that makes a new all-time high every quarter. So, you know, equity prices will tend to follow that.
Well, we didn't have a drawdown last year of anything near 2%. We didn't have one day of where we did that. So 28.
Yeah, it's really interesting that because it looks as if QE has compressed volatility in most financial markets, and in fact, it seems to have compressed volatility in equity markets more than in bond markets. Because if you look at volatility in bond markets, it's down, but it's not extraordinarily low. Whereas for equities, it does look almost anomalously low. So our expectation is that with QE being dialed back and the Fed looking to shrink its balance sheet, the ECB looking to reduce the amount of support that it gives, then it would be no surprise to see volatility higher. And, you know, those drawdowns that have been very, very small in the last 12 to 18 months could be somewhat larger this year. But I think as long as growth holds up, you have to hold your nerve.